The money in the trust is meant to fund your lifestyle and meant to help you have a great life with your family and friends. And so what we're looking to do in today's episode is to understand how the two relate to each other, how to make them speak to each other. It's useless growing a lot of money, building a lot of wealth if you don't know how to use it or how much you're allowed to use. Welcome back to the Enough Club. I am Bryan Nicol.
I'm Pieter Villiers.
And today we're continuing with our series on trusts. This is episode 2 in a series of 3. We're going to be talking about how to coordinate your family trust with your personal financial planning. Why is this important and what does this mean? So firstly, coordinating your family trust, the money you've got in there, your capital, with your personal financial planning. In other words, what do you need this money for? What are the things you want to spend money on in your life? What are the things you want to see, do, experience, own? The money in the trust is meant to fund your lifestyle and meant to help you have a great life with your family and friends. And so what we're looking to do in today's episode is to understand how the two relate to each other, how to make them speak to each other. It's useless growing a lot of money, building a lot of wealth if you don't know how to use it or how much you're allowed to use. What prompted this episode specifically is an experience we had with a client. This family, they were in a situation where they had a lot of money inside a trust. And they inherited this money from, the parents and grandparents over the years. I could tell from the outset that they were going to be well off for the rest of their lives. But they didn't know that. They didn't know what that trust capital could do for them. They didn't understand what their current lifestyle costs. They didn't understand how much it costs for them to live the life they want, to shop where they shop, to travel every year where they travel to. And so there was a disconnect. So the money was being managed in a way that I would say is not necessarily 100% aligned with the returns they needed to produce to fund their lifestyle. And because there was this doubt, the family started kind of shutting down. They became very conservative and frugal. They were afraid to draw money because they were afraid it would run out. So they didn't really want to take too much money from the trust, and they were denying themselves simple pleasures which they could have had they known what they needed to know. Simple pleasures like not going overseas to visit uncle and aunt in that other country for the big birthday or whatever the case may be. And so you could get this kind of situation or syndrome where you become the poorest wealthy person in the world, where you might have a lot of money lying in a trust, potentially, that you or your family or previous generations have built up lovingly for you over time. But now you're not allowing it to do what it needs to do in your life. And that is to fund the lifestyle that you want and to do meaningful things with the ones you love. So with that in mind, we want to today go through a few points to help you understand why it's important to align what happens in the trust with what happens in your life. So I'm going to hand over to you, Pieter, and I want you to talk about how the trust capital can be an engine for you and your family's lives.
Yeah, so it all always boils down to when we put together any investment portfolio, you always have to take a step back and understand what are we investing for? Because we tend to kind of go down the route of, I just want the best fund on the cheapest platform and I want to save fees and be tax efficient and all of that. But if that doesn't serve the purpose of helping you live the life you want, then it's pointless. It's like I've got money, but I'm not able to enjoy it. And having the understanding of what is enough, that takes some time to really do a bit of introspection on your current lifestyle. What do you want to spend money on? What is money meant to do for you, in your life? And where do you see you can use money as a tool to live that life you want? So when you have a trust, it is a different entity where it's differently managed. It's not something, in your name, but it should still serve your lifestyle. Because that was the whole point of creating it. It was to become a bit more tax and cost efficient initially, but it should still serve you and your family. So what we always try and do to understand, let's say we have to give advice on the trust assets, we don't start there. We don't dig into the numbers and see what it's invested in and start making changes. Always start with the person, the beneficiary of the trust. Because if we can spend some time understanding what is it important to you, we can quantify the cost of your lifestyle, your desired lifestyle now and in the future. And, it might be like I need X amount per month for my day-to-day stuff. And it might be capital amounts that I need every couple of years, to buy a new car, to go overseas, or to buy a house. And those things we need to understand. We need to know about them, because when we look at the investments in the trust and the income it should provide, those two should connect. Because no point we having a lot of wealth in the trust, but be scared to take money out because we don't know how long it's going to last. It's like trying to look through a broken mirror. So when we have clarity, the mirror will become clear, and we can understand. Well, I need I need to earn X amount per month. In addition to my job, I need this amount. All right. So then that portion of the trust, let's say for 5 years, can be invested very conservatively. We don't want to take risk. We want that income to pay out to fund your income. But let's say you have kids that you want to send to university, and they're still young, it's still 10 years away, then that portion of the investments can be invested more aggressively, because the purpose of that bucket is to fund education. And so the same we do with personal financial planning. When we have our own little goals that we have, that should also speak to the trust, because the trust can enable those goals. But if everything in the trust is just sitting in cash, you're going to pay a lot of tax, first of all. And also, you're going to miss out on massive growth. In the previous episode, we mentioned that trusts don't die. So if you think about a long-term investment term, trust is the longest because it doesn't die physically. But equally, we don't want to put everything in equities if the purpose is actually to fund an income every month, because then the risk is too high. The markets might drop, and then the capital in the trust could actually deplete. The same thing when we have hard assets like property. Do we keep the property and use the rental income, or do we sell the property and use the capital? Before we really make a decision on that, we need to take a step back and understand what is the purpose, what it is actually meant to do for us in our personal lifestyle. And maybe you don't need that capital. It's intended for your children and your children's children. Then that money should absolutely be invested quite aggressively, because it's a long term. So when we look at the trust in itself of all the assets, we almost also need to create buckets of purpose, what purpose it's intended to serve. And then based off that, we can understand the term and then decide on the asset allocation. Is it 100% cash? Is it cash and bonds? Do we add a bit of property? Do we add equity? Is it only equity? Are we thinking about offshore assets at this point? And that's why when you have a trust, you need to have someone that can look into both those sides. You can't have someone on this side doing their own thing, running around, and then someone on this side planning independently. They need to speak to each other. It might be that you have a whole team of people helping you, because the trust is quite a complex thing. You might have an accountant and an attorney and a financial planner, but they also need to speak to each other, because every decision you make on the trust is going to have a sort of tax implication that you need to coordinate with the tax guy to make sure that you do it the right way. So it adds complexity to the plan, but it doesn't mean it has to be complex. As long as someone can explain it to you and it can serve you in the lifestyle that you want to live, I think that is the whole purpose of the trust. It's not just it's not just something that you kind of put on your fridge and flash around to say how much wealth I have. It is supposed to be fulfilling a purpose in your personal life, and you need to understand that picture first before you can really make decisions on what the trust has to do for you.
Yeah, exactly. So the thing about money is that it's always related to everything else in your life. So any money that you have it impacts every part of your life, and every part of your life, every transition you go through, every decision you make, it impacts money. So the money that you might have in a trust, it is definitely needs to be aligned with the life you want to live and how you use that money. Now, what we have, and the reason why this point of aligning everything is so important is because what often happens, what we have found over the years is we work with a family and we see that there is a family trust in the mix. And so there is a trust administration firm that is helping with it. And then over the years, either within the trust administration firm, an advisor has started working on the investments. So they manage this money, and they're kind of more investment advisors. So these investment advisors will think, well, this trust must last forever. We're going to invest the money in this way or that way. Or I once had a chat to the beneficiaries, which is the family who receives the money and the capital, and they seem super conservative and worried about money or something. And so we're going to invest very conservatively. Now, that might sound great. I think it might probably be legally okay, regulatory wise, you covering your bum by giving advice that rather conservative. But at the end of the day, if you don't know what that person's doing in their lives every day and what they use money for, you can't really go about investing that money knowledgeably. It will be a hit and miss. So what we have seen is that we come on as financial planners with the family, and then there's another potential advisor working on those investments. Now, that's fine if you want two advisors working across two different spheres. One with your estate and your family's estate, your personal finances, and then another one managing the trust itself. Then there's got to be really good open communication between the two. Because when you have a family meeting and you discuss the trust and you discuss the money, you need to bring that financial advisor in, the one that helps you on your personal side, to understand what's happening in the trust. Because if this is the economic engine of your family, if this is the financial engine, everyone's got to be singing off the same script. You can't be doing something really high risk with these investments when I know next year you need 4 million Rand to purchase a property in your personal name and not necessarily within the trust. So where's the money that's kept aside for that purchase? So these are the uncoordinated issues that we find. It's an issue of a lack of congruence or integration between the different areas of your lives. The same might happen with a business. If you have a big family business, it creates income, profit, dividends, and it distributes to all of the family members who are employed in that family business. It needs to speak to personal finances. How much do you actually need from that trust or that business to earn to live a nice life? And how much can the trust or the business afford to give you? You need to marry those two factors. So, I want to kind of hand over to you, Pieter. Maybe just talk us through, like, high level, something we have seen at Freedom with a family that we serve, where this lack of coordination looked like it was going to become a problem.
Yeah, it's I think probably something quite common when we work with families is the first meeting we always have, we call it the all about you meeting, is just understanding their lifestyle. What is really important to money to them? We don't really look at the numbers at this point. We just want to understand, what do you do for fun? Where do you see yourself in the future? When would you like to reach financial freedom? What does that look like? So we ask a lot of intentional questions to really map that out. And oftentimes what we'll find is, the lifestyle that the client wants to live is going to be sustainable for a very long time, based on what they are currently doing. And then we're also aware of the trust. But then when we go a bit deeper, then we understand that, all right, but there is actually a couple of things they want to do in addition to their current way of living. They actually wanted to go on that Europe trip for quite some time, but they can't afford it. And they don't think they're ever going to get there. And then you look at the trust and like, no, but wait, there is a lot of money here. What about that? And then there's just no communication really there. It's just like, yeah, but we're just investing it. And funny enough, we always talk about when people don't know when enough is enough, or they don't know if they have enough. And this problem doesn't become solved if you have a lot of money, even, because a lot of people that has a lot of money, many millions, many multitudes of millions, still don't know if they have enough, because there hasn't really been a calculation done to understand if this is my enough, if this is what makes me happy, I need to earn this amount per month or per year, and then understand that, all right, well, the capital that I have can make this possible. And then your life changes after that, because there's clarity, there's peace of mind. It almost becomes liberating. So what we have seen in practice is when we do the personal planning, the type of lifestyle we're trying to achieve is almost misaligned to the type of lifestyle that can be achieved, because the trust is not really serving the purpose it's supposed to. And then after going into the trust and understanding that, oftentimes we able to bring a lot of clarity to the type of life the client can live. And I think that is where we spoke about, if you add a trust to a picture, you add a lot of complexity, you add a lot of different people, different professionals to the game, because there are so many things to think about. And, there's a lot of cooks, it could spoil the broth. So you need to have a coordinated strategy where these people are all in the same room and speaking to each other. Because at the end of the day, it's your money, it's your family's money, and it should serve you. And the people that are helping you doing this, they should earn their keep, and that always just comes down to communication, clarity. And once you have clarity on exactly what's going on, I think life just becomes easier because you don't necessarily have to stress about things anymore that you used to stress about because it's already been provided for. It may just have been mispurposed up until the point where the clarity has come into the picture.
Yeah. And you touched on something I want to kind of dig into a little bit deeper there quickly. You talked about how much is enough. A family needs to understand that. And so you might have a family, maybe the children are all adults out of the house, they're living their lives, they got their families, they got their jobs. The parents are kind of the matriarch and patriarch, and they've got there's this trust, this family trust. And so maybe there's businesses in it or whatever. There's generally going to be a lot of capital that's invested. So money in the markets, money in ETFs, unit trusts, share portfolios. So what's the way we would do it is to keep it super simple. And this is something that anyone out there listening to this or watching this can now potentially try and apply, is to understand what the lifestyles of all the beneficiaries cost. So if mom and dad need 100,000 a month, and if they've got one child, and one child needs 60,000 a month at this point in time, and that is what they need, they can work back to see what a sustainable withdrawal rate is. So if it's 3% a year, maybe, if they're happy with that, 3%, how much capital do you need, and how should it be invested to produce 3% growing at inflation every year? You work that number out, and you can ring fence that in the trust and say, this is the money, the capital, the investments that are going to be invested in things that we can make withdrawals from that can potentially fund our everyday lives. Then thereafter, you now know that this is what we need to have enough, and we are comfortable with that. Now you can get creative with the other ones. You can start saying, well, there was this great opportunity to buy into another business for the family. There is this great opportunity to purchase some properties, Atlantic Seaboard, Cape Town, that we can rent out and build up a property suite, a portfolio. So you now know what you can afford to not get a return on investment yet. You can make that money sweat for you, and the other money must be kept aside. That's when you start simplifying life and you start building a puzzle with just a few big pieces, and you know exactly what the picture looks like. It's not that complicated. And so trusts, as technical as they are, once you have the right people, I think, overseeing the management of tax, the management of the contracts of it, distributions of income and capital, once that's in place, it starts to become quite simple in a sense when you know what you need to know about the capital and what it needs to do for you. And so if we look at someone's, how capital is managed, whether it is in a trust or outside of a trust, but we'll focus on a trust for now. You first need to understand the beneficiaries. What is their lifestyle cost every year? Not just in the debit orders, not just in the monthly expenditure. You know, next year you might have to upgrade your car. You know, 3 years down the line, you have to repaint your house or whatever the case may be. You know, every year you go to a Formula One race somewhere in the world. What do these things cost? Quantify that. Come up with an annual figure of money you need after tax in your account. Then you can start determining if you have enough or not. You can also determine from that an asset allocation for your investments in the trust. That is why the personal side needs to speak to the trust side. Personal advisor or financial planner needs to potentially either manage those investments, because now they know everything about you, your children. They're the family person or the family firm, or they need to have a very good relationship with that advisor who's managing the investments in the trust. Basically telling them, this is the outcome we need. Structure something, do your magic, create a portfolio that will do this, get us inflation plus X amount every year. And so that is how we determine asset allocation, just generally speaking. It's no different with a trust. So with this unity, everyone's speaking the same language. Then you have less stress around the trust, less conflict, less unknowns, fewer unknowns. And that removes the anxiety from your life. And you can just enjoy what you've built and worked hard to build over time. It need not be stressful, and you need not be bamboozled by people who are trying to make it sound super complex, maybe just to justify their jobs or existence. It doesn't need to be that bad. So that's why we're doing this series, is just to try and help you understand what you need to understand to know if you are doing things optimally for your family. So in closing, it's if you look at the coordination, the trusts, everything is related in your life. The money that's outside of the trust, the lifestyle that's outside of the trust, is related to the capital within the trust. And as Pieter spelt out pretty well earlier on, the allocation of the investments within the trust and what it's meant to do for the family, there's got to be a complete understanding by all the role players so that everyone knows that it's been managed with the family in mind and whatever the goals are for the family. Pieter, before we close off, anything you want to add to that?
Yeah, I think it just comes down to communication. When you have a team of people helping you, they're all going to earn their fees. They need to earn their keep as well. And for you as the family, it's your money, and you should understand how that's meant to serve you. And if there's no clear understanding or no clear plan, then there's a problem, and that problem needs to be addressed. And although trust can become complicated, it doesn't have to be if you follow a simple framework that you understand why are we doing what we are doing. And at the end of the day, to just bring you a bit of clarity, confidence, and even competence to know that you can live your life in the way that you want to, and you don't have to stress about money, and that you're always keeping a tabs on where everything is. And also, if you multi-generational family, to involve the rest of your your children and their children as well, so that they also have this understanding of what is going on. So I think for the next episode, we are going to touch on, we've talked about the trust now, but the benefits that a trust bring. Is there maybe other structures that we can consider that will get us very close, or even more benefits than what a trust could add to our family? And this is going to be specifically for high net worth families, those who have a lot of wealth. Whether the trust could make sense, or maybe other types of estate planning structures that we can also consider. So that's what we're going to cover in episode 3. And hopefully that will then wrap up the series so that you guys can ultimately make that informed decision.
Thank you. I trust everything you're saying, Pieter. See you next time, guys.
I was like, cheers.